everyone, and welcome to the Everyman Investor. Apologies for being a bit late to the party, but I was off on a holiday last week. So anyway, the Fed came in peace this time round, and dovish Fed usually means bull market ahead. So let's take a look at the way ahead for us investors. Now, for the Federal Reserve meeting, I got the data from federalreserve.gov. Okay, so this is what was discussed and what was sort of came out in the press conference. So interest rates have likely peaked. The chairman actually mentioned that he is quite confident that this is basically it, and that further raises are not likely, although several Fed members have since tried to sort of walk that back and say that if necessary they'll raise rates further. Now, rate cut discussions are also likely to be part of future meetings. This again came from the chairman himself and was revealed at the press conference after the meeting. Long-term GDP growth was estimated to be about 1 to 2% through to 2026. Now, you can get this from the details of the meeting itself on the website, as I mentioned. And unemployment is expected to rise to about 4% through to 2026. Core PCE is expected to drop to 2% by about 2026 as well. And this is basically the long-term target for the Fed. Now, let's take a look at the dot plot. I mentioned the dot plot a couple of times previously. Now, this basically shows us where the members of the Federal Reserve think interest rates will be in the future. Now, as you can see in 2023, it was a common consensus that interest rates would be somewhere between 5.25% to 5.5%. Now, what is happening now is that the current dot plot shows that in 2024, the majority of Fed members think that interest rates will drop to about 4.5% to about 4.75%, which is basically 3 rate cuts from where we are now. Now, looking further on into 2025, we can see that the majority of Fed members think that the interest rates will be about 3 to 4% or thereabouts, which is another 2 to 6 rate cuts if they do a quarter point rate cut from where we were in 2024. And further on in 2026, it looks like, and further on in the longer run, it looks like the Federal Reserve thinks that interest rates will stabilize at about 2.5% or so, which is about half of where we are at the moment in time. Now, in all, it shows that basically the Fed thinks that interest rates will be coming down. They'll be cutting rates over the next couple of years through to 2026, and this will be good for economic growth and good for companies' earnings in general. Lower interest rate means lower borrowing costs. Lower borrowing costs means more profits for the companies, and also more expansion, given that they can borrow money cheaply or less expensively for their own expansion plans. So, as investors, though, we need to be aware that there are risks involved in any scenario. So let's take a look at what is the potential risk that I identified in 2024. Now, the first and most important risk is that the Federal Reserve gets the economic outlook wrong and that unemployment rises more than expected. Now, in the past couple of weeks alone, several other companies like Hasbro, for example, have announced job cuts, and a toy company announcing job cuts in the Christmas season is really not a good sign. If unemployment rises more, then there's a chance of recession, and that will lead to more rate cuts, which means to say that bond yields will fall, because basically bond yields sort of track interest rates. So as interest rates fall, bond yields will fall as well, and there goes your 5%, which was just a couple of months ago, and it'll be down to maybe say 3% or so for the 10-year Treasury yield. Now, the second risk is the US presidential election. Whatever side of the political spectrum you're on, outside independent observers and ratings agencies have mentioned that the current governance in the US is really not conducive for the markets, in the sense that there is too much antagonism on both sides, mainly from a particular wing of a particular party, and it would be good for the US government to go back to where it was previously, whereby there are still two sides. But the thing is, after arguing in governance, they can sit down and have a drink at the pub after the official session is over, which is not going to happen based on how things are at the moment in time. So the best potential outcome for the presidential election for the world and for stock market in general is that a person who is willing to accept um, results from an election without spewing conspiracy theories and is willing to govern by reaching compromise, sensible compromise with the other side, is elected to the presidency, and hopefully a particular wing of a particular party dies off once the leader is sort of sidelined if the presidential election works out right for most people around the world. Okay, the other issues are conflicts around the world. So basically, the Ukraine conflict, the Russian invasion has not ended. The counterattack by Ukraine basically didn't achieve as much as what many people wanted. Um, will it end next year? It is hard to say. But the thing is, there is fatigue setting in among various backers of Ukraine. Um, and the problem is that, again, the US has issues with giving aid to Ukraine because of the governance issue. Then there is the Middle East. So the conflict between Israel and Hamas is already a problem, and it's a great tragedy. But now there's issues in terms of the Red Sea, whereby Houthi rebels are actually threatening shipping, which can affect supply chains and can cause potential inflation to increase again, as shipping companies have to reroute round the Cape of Good Hope rather than through the Suez Canal, which will add time and money to transportation costs for those ships that travel in that route, which are very many. And then lastly, a Black Swan event. So the most obvious one will be Taiwan and the Chinese invasion of Taiwan, which will again lead to further problems in terms of diplomacy, basically sanctions. And Taiwan is the world's largest producer of semiconductors, which again leads to supply chain issues, not to mention casualties in the event of a war. So, what is the plan and what are the tactics that I am adopting looking forward into the next year, or looking forward from now on into the next year? So this is my game plan for 2023N and 2024. So I'm locking in higher bond yields now because, as I mentioned, when interest rates get cut, bond yields will fall. You can either buy bonds now, which I'm not doing. What I'm doing is I'm buying bond funds while the net asset value is still low. So as the bond yields drop, the price of bonds go up, and the net asset value of various bond funds will increase, which basically increases my dividend, which is excellent. But the thing is, if I buy it later on, I'll be paying a higher price for something that's much cheaper now, given that interest rates are still high now, and hence bond prices are low. That hence the net asset value is low. I'm watching multiples on stocks because many of the mega cap stocks have got very elevated P ratios at the moment. On the other hand, small and mid cap stocks are trading at good value and they are catching up. The market is actually broadening out. So some of these stocks are actually good stocks to pick up at the moment in time. I've actually picked up a couple of stocks recently, and also a fund recently. And these are stocks that sort of dropped over the market gyrations from profit taking, and basically these are stocks that should do better in a lower interest rate environment. Now, buy on dips. So basically, the broad market corrects once every other year, or on average. Bear markets happen, depending on the stats you read, about 4 to 7 years, once every 4 to 7 years. So the thing is, it's not unusual for market corrections to happen. In fact, slight correction happened recently after the market was overbought, right after the Fed sort of boosted the market, and the market just dropped again yesterday, probably from a lot of profit taking. So there will be opportunities to buy on dips. So I would say that know your companies that you want to buy, know the multiples they're trading at, and basically if they dip below the median PE, that's usually when I go in. If they dip a lot lower than the median PE and things look right, I definitely will go in. The other way to do it is to buy on bad earnings. So as I mentioned, I bought Fortinet on a so-called bad earnings report, and I'm up. I think at last I saw was about 33% from the buy price I had at the time. So basically, there is no need to chase the rally or to chase the market. Um, if you have got, I would say, 10 to 15 stocks on your watch list or in your portfolio already, know those stocks well, and it's not difficult to have a sort of portfolio from various free websites. Simply Wall.Street is one, where you can just open up every day and see what the movements have been, and hence give you opportunity to look to see whether or not something has happened that will help you buy at a better price than what you would have if you had chased the rally. Now, the last thing I would like to mention is basically on semiconductors and the AI story. So recently, both AMD and Intel have actually announced their own AI chips, and Nvidia's sort of sales to China have sort of hit a snag with the US regulations coming in, with the US trying to stop China from getting advanced chips. Full disclosure, I own Nvidia and I own one of Intel or AMD. The thing is that I'm expecting the AI chip market to become a lot more competitive. While the performance of both AMD and Intel chips are probably not going to be what Nvidia's chips are able to do at the moment, the prices will probably be a lot lower, and already big companies like Microsoft, Amazon have committed to buying AMD's chips because of the one availability, there's no backlog, and two pricing as well. Um, will Nvidia continue to be the big sort of story? I would say it is going to be a big part of the story, but its dominant position will probably be eroded over time, given that companies like AMD and Intel are aggressively inventing, reinventing, and pushing out new AI chips at a lower price, albeit at a lower performance, which I expect the performance gap will close over time. So it is probably a good idea to look further afield than the very big names, and see where the discounts are, and also to see whether or not other companies have got their own unique advantages. So, for example, in the chip space, AMD's advantage is that it is already into the AI sort of chips game. It is also planning to get into the PC chips sector, and as PC demand improves, which is expected to improve in 2024, it is another revenue stream. Now, for Intel, on the other hand, Intel is also involved in the AI chips race. It is already dominant in the PC chip sector, and it has got a lot of investment ongoing and a lot of construction ongoing into building plants to manufacture chips for various customers or itself. Um, Now, with the current climate, onshoring or friendshoring is going to be very important. And I would say that look for companies that are sort of retreating from China and are investing in infrastructure in other countries, like for cheap labor will be Vietnam, Thailand, even Malaysia, Indonesia, and also those countries that are building infrastructure in Europe and the US, for construction of various essential materials that run our world. These are the companies that would probably be a lot less affected if, for example, say China invades Taiwan, because they would not have assets that will be frozen or assets they have to write off in that event, like many companies did with their Russian assets when Russia invaded Ukraine. So, I hope this was informative and useful for your own sort of planning for your portfolio for the next year. Is by all accounts, by most accounts, supposedly going to be a very good year for the market. Most people or most analysts that have read expect a correction or a dip, at least, because the market is quite overbought at the moment before a resumption of the bull market rush into higher prices. Um, at the same time, there are economists and analysts who are predicting that the S&P 500 will end at 3,006 next year, at the end of next year. But that is honestly a worst case scenario, and I personally do not see that happening, short of many disasters in the risk that I identified all occurring at the same time. So happy holidays. Um, Enjoy the time with your family and your loved ones, and I hope that the end of the year, hopefully there'll be a nice center rally for us, and then 2024 will be a profitable year. And so thank you for watching, and I hope to see you soon in my next video.